Hello, welcome to this iGrow broadcast. This is part of the Managing Change seminar series put on by the Department of Economics and SDSU Extension. This week, I'll be taking a look at cattle markets and risk. My name is Matt Diersen. I'm a professor of economics here at SDSU. We'll take a look at our outline here for the talk today. We'll take a look at some input prices. They've been part or a big source of risk here in the cattle markets. We'll also take a look at the cattle cycle from two different perspectives. We'll look at the cycle from the U.S. and we'll also focus in on what's happened in South Dakota, which is sort of representative of what's happening here and in neighboring states. And we'll look at a couple of structural shifts because it has implications for what we're likely to see here in the coming years. We'll look at some price projections, and then scattered throughout, but especially at the end, we'll be looking at some risk levels that we see or some risk scenarios as we go forward. Let's take a look at those input prices. We'll start with the big one here. We take a look at corn. The price of corn for this marketing year, that'd be the 2012 marketing year, so last year's crop. The price in South Dakota right now is sitting pretty much at the same average level that we saw last year at this time. So no relief in sight from the cattle feeding side of things. The implications as we look to this fall are for a slight break in prices if we get a bigger corn crop, and that should bring some relief on the feed side of things. The other thing, if we look at the corn market, is on the future side of things. We're looking at what you might do to lock in feed needs at this time. Maybe you want to take a look. We've got the nearby contract hovering around $6.90 a bushel, but from then on, or moving forward from there, we have an inverted market. So we get a sharp break by the September contract, and the new crop 13 contract has been hovering or trading around $5.50 a bushel. Also, if you want to take a quick look there, you can see that you've got the December 14, 15, and 2016 contracts trading all at a discount to today's price level. What is the implication for cattle feeders? Perhaps going hand to mouth is what the market signal you're getting at this time is, so that you would buy your feed needs as needed, even as we get into the new crop. The other input price that's sort of had its problems or its carryover into the cattle side of things has been hay prices. The hay market across the United States has been very high, driven by low production this last year, which has resulted in very tight stocks. The prices nationally are the highest down in the southwest United States, and the relatively low prices down there in Texas, where they had a substantial or very large production year for grass hay. In the northern plains, the prices continue to be high enough to sort of limit any kind of expansion plan. Focusing in quickly on one last aspect of the hay market, really what's driving things in the short run, and it'll carry over as we get into even the summer, has been the very tight supply of hay. Nationally, you've got a 40-year snapshot here of U.S. stocks on December 1st and winter use or winter feed consumption of hay through May 1st of the following year. So when hay stocks are plentiful in that 105 million ton area, we tend to consume a fair amount of hay nationally. This year, however, we're down at the very lowest end of the stocks seen in the last 30, 40 years. And what that means is if we follow historic trends, we won't consume very much hay at all, putting us right down there in the bottom left-hand corner of that 60 million ton consumption area. What that means, both the short run and longer run picture for hay is very high price levels, which is going to limit any kind of switching for feed use and any kind of expansion in the short run until we get the next summer taken care of. The other area that's our last feed price indicator that's sort of relevant this time is the grazing rates or grazing fees we're seeing across the United States. And here we've got South Dakota in particular, just to see the progression during the last several years. Regardless of the type of animal or type of pasture you're looking at, animal unit and cow-calf pair, the cost per hundredweight or the rate per class for the last several years per month here has crept up year over year. Last year setting very high levels, especially for the cow-calf pair in the low $30 area. If these high feed prices, corn and hay, continue, fully expect grazing to be very profitable on paper this summer. So if there is adequate grass there, it should command a fairly high price, pressuring all those rates to move higher throughout the coming year. We're going to shift gears away from some of the input prices now and focus on some specific cattle prices and overall trends in the market. First, I want to highlight just a few sources of market information here to give you an idea of where some of these other prices I'll be talking about are coming from, so you can go and look these numbers up or double check my facts. Taking a look, we've got the CME as the source for futures and options prices. Their website's listed there, cmegroup.com. The cash prices are going to come from the Agricultural Marketing Service primarily. These are cash prices of graded sales. You've got the ams.usda.gov website. And the third one is the Livestock Marketing Information Center, or LMIC. Note their website is lmic.info. The LMIC is supported by South Dakota State University. They provide some data summary and analysis, and they share that with us or give us access to that. So some of the charts you're going to see are directly from or provided by the Livestock Market Information Center. So let's take a look at a few of those prices and what they've done in recent years. Here's 4 sets of prices, all specific to South Dakota. We've got the top price series there being the stocker price. That's a 5 to 6 weight steer calf. The feeder cattle is a 7 to 8 weight steer. The live cattle is a 1,200 to 1,400 pound steer. That's out of the Worthing, South Dakota Sioux Falls Regional Livestock Price Series, and the same with the cull cows. That is also from Sioux Falls Regional Price Series, reflecting medium weight breaker graded cull cows. How do those price series come out, or how do they play out? It all depends on what happens to cattle inventories. If we take a look at the cattle inventory, cattle cycle here, we've got January 1 inventories going back. So you can see the last few cycles. As inventories build up, cattle prices tend to fall. Taking a look at a different perspective of those cattle cycles, here's the last several cycles laid out on top of one another. You can see our current cycle there, that dark blue line in the middle, showing we're in that decline phase as we take cattle inventory numbers down. Now we'll come back to these cattle inventory cycles a little bit, but I want to put this year's cattle numbers into perspective. That first chart showed we've got the cattle inventories declining steadily, and where or how does that play out when we look nationally? We've got a couple of maps here that I think show this pretty well. This first one has total cattle inventories by state. The darker the state, the bigger the inventory of cattle. So throughout the Central Plains, Northern Southern Plains, fairly large relative numbers of cattle in those states. And this also puts in perspective, where the cow number is going to come from that would drive a calf crop. Heavily concentration in Texas, Missouri, and then up through South Dakota. But to put this in perspective, let's take a look at this map showing the change in cattle inventory numbers from the beginning of 2012 to the beginning of 2013. Here you've got the states in dark blue added inventory this last year, and the lighter the state, especially the white colorless states here, actually dropped inventories and dropped them sharply. So you can see clearly that in the Southern Plains, the impact of their drought conditions really took the cattle numbers down overall. They'd already been declining in states like Texas. This just made the problem even worse, and we continue to see sort of stagnation or declines in the numbers as we look in the eastern corn belt or through that Illinois up to the Ohio River valleys there, where we've taken inventory numbers down, and it's very hard to rebuild those inventories in those states once they're lost. We've got a couple other things related to the cattle inventory and cattle cycle for perspective. First, we'll take a look at the feeder cattle supplies rather. These are feeder cattle outside of feedlots. Take all the cattle inventory for steers and heifers and calf crop, take out the number on feed already and heifers deemed replacement heifers that may or may not already be bred, and what you've got left over with are feeder cattle supplies outside of feedlots. The trade and myself were expecting this number to be down slightly from last year, but you can see here for 2013 there was a slight increase in feeder cattle supplies outside of feedlots. What are the implications of this? Well, it's twofold. First, you have a little bit of a surprise that's sort of working its way through the market right now, in that we've got inventory levels of cattle available to restock the feedlots down a little bit. This has weighed on the feeder cattle market slightly and sort of relieved a little bit of pressure from feedlots. And moving forward though, as sort of a bottleneck of cattle inventory on feed and remaining to go on feed gets worked through, probably by the second half of this year, you're going to see fairly strong pressure, increasing prices of stocker and feeder weights just because of limited supply. Just because that price or that inventory level is up slightly doesn't really mean a lot, because the overall inventory, the overall level is still very low compared to the numbers that we've been going through or using in the feedlot side of things in recent years. The other set of numbers to take a look at to sort of provide some historical perspective is beef heifers held as replacements. Now, the trade also made a sort of a big deal about this, saying that there's expansion happening because replacement heifer numbers are up. They're up for the third straight year. However, it's really not a good indication of any kind of expansion, because the increase in heifer numbers, even as big as it is, doesn't match the sustainable levels when you've got just normal cattle inventory levels, and it doesn't match the reduction in beef cow numbers that happened the last couple of years. So we've taken many cows out of the inventory and replaced them with fewer heifers than normal, even though it was an increase from last year. The net result is fewer cattle that will be having calves, fewer cows or heifers that will be having calves during 2013, further reducing the cattle inventories and the U.S. cattle cycle level. A couple other charts here just to focus quickly on South Dakota. South Dakota had been running fairly stable or consistent cattle inventory numbers. You can see here we've got the cattle inventory chart going back to 1943. Recent years fairly stable. In 2013, a slight increase in cattle inventories compared to year-ago level. It was driven by a few things. If we take a look at some of the details or subcategories, the cow numbers were up last year. That resulted in a slightly larger calf crop in 2012. That means we've got, with a slightly smaller number of cattle on feed at this time, we've got a slight increase in feeder cattle supplies outside of feedlots. So cow numbers are about steady, but that calves and lighter weight feeders that just haven't made it into feedlots yet are what's driving a big part of the overall or aggregate increase in South Dakota's cattle inventory numbers. Now, we've got a few different charts here that show how the U.S. cattle cycle sort of plays out or is expected to play out in the coming years. First, we've got to look at the U.S. inventory level coupled with the calf price. Now, this is the USDA's nationwide calf price, but it does match up fairly well statistically, or there's a fairly high correlation between that calf price and the price of 5 to 6 weight steer calves sold in the fall in South Dakota. So it's going to be fairly representative of what you can expect to see as long as history repeats itself moving forward. So this chart itself shows that we've got inventory numbers in 2013 that are expected to further decline in 2014 before rebounding gently or steadily as we go forward all the way out to 2022. At the same time, the other line here is the calf price, and that is showing a slight increase in calf prices in 2013 from 2012, but again, higher prices in 14, 15, and 16 before dropping off slightly in 2017. Bottom line, if you follow the USDA's baseline projections based on the fundamentals, where they see cattle inventory numbers and where they see calf prices heading, you're looking at 5 continuous years of very profitable levels moving forward. Now, if history doesn't repeat itself, we're more likely to see situations like the following. We went back and looked at how does the USDA baseline inventory number sort of track, or how well does it work when we look at it through time. So if we go back to the first year where we had a baseline projection that included 2013, it would have been back in 2004. In 2004, the USDA baseline was to have sort of this increase in inventories. This is just inventories here, but an increase in inventory out to 2013. And we should be sitting with about 102, 103 million head of cattle at this time. That's really not how it worked out. If we fast forward and look at 2007 and the projections at that time, we were to see the cattle inventory quickly peak and then decline as we get into 2012 before eventually rebounding and increasing through time. But even then, we were looking, if you focus on 2013, we were going to take the inventory numbers down. Fast forwarding again to 2010, just a few years ago, you can see now that the expectations were for the cattle cycle to shift way down as the price of corn and drought conditions weighed on the market a little bit. And then how did it finally play out? If we fast forward to 2013, we can see here how the actual has played out through 2013, and now we've got the current baseline projections putting in the bottom next year before increasing again. Again, what does all this mean? Well, if we think about the ramifications of this, if you're using the baseline for price projections and making some long-run recommendations or using it for longer-run analysis, you do have to kind of take it with a grain of salt. You do need to kind of discount or take conservative estimates when you're making your planning prices, because these are the very types of price levels and inventory numbers that feed into price projections that are necessary and useful when you're doing things like placing a value on bred animals or coming up with pasture rental agreements when you've got more than just the 1 year to consider. I'd like to shift gears now and look at a few other structural indicators real quick, give you some idea of what's happening in South Dakota and neighboring states. If we take a look here first at the monthly volume of cattle from feedlots in the northern plains and eastern mountain states, this would be Montana and Wyoming, over the last several years, we do have the volumes of inventories from these states that were sold directly to packers through mandatory price reporting. So these are typically larger feedlots selling to larger packers, but you get the general idea that we're looking at somewhere in the neighborhood of 80,000 head per month, and there's a slight seasonal pattern with a little bit of increase in July and November in any given year. The 2013 numbers, we see those there. Here for the first couple of months of 2013, those inventories are down in that 60,000 head area, so we do have a slight decline in cattle inventory levels coming out of the northern plains states, but it's consistent with the slight declines we're seeing in overall or U.S. aggregate cattle inventory levels. To put that 80,000 head or 60,000 head, whichever one you choose, into perspective, we take a look at the South Dakota feedlot activity. Here's the average marketings and placements by large feedlots with more than 1,000 head for the last 5 years, just for South Dakota. And you can see you got a fairly smooth pattern month to month with the marketings. They tend to be in the neighborhood of 40,000 head. So about 2/3 of the cattle being supplied out of the region right now would be coming from South Dakota. And you can see you've got a fairly high seasonal spike or fairly strong seasonal pattern throughout the placements as they decline in the midsummer and then have a pretty sharp increase when we look at October and November. Moving ahead now to price projections. We've got a few different sets of projections here. We'll start with live cattle price projections. These come from the WASDE report, the World Ag Supply and Demand Estimates. So just overlay those price projections when they come out against the live cattle futures prices at that same time. So what we see here is a point-in-time snapshot, and this chart is telling us that we've got a disparity between where the futures prices are and where they potentially could move based on fundamentals. So a fair amount of upside potential in those projections. Those futures could go higher as we look at the remainder of 2013. What this projection chart is telling us is that we do have some upside here. So how do you take advantage of that? Well, there's two ways. One would be through something like an option strategy where you would buy put options and leave the upside open, or a strategy such as livestock risk protection, which functions the same way and leaves the upside open. We have to take these futures prices though and keep in mind that we have a basis adjustment necessary because this is South Dakota. We've got some disparity between the cash price with a fairly strong seasonal pattern through time that's going to affect price levels we're likely to see in reality. So what we've got here is a price comparison using a cash price for the Sioux Falls regional fed cattle market relative to the live cattle futures prices. This comparison, you can see a fairly strong seasonal pattern when you look at the 5-year average, and then we've got 2012 overlaid in there for comparison purposes. So for example, in the month of July, we had a fairly large, wide basis last year on live cattle, and that just shows what can happen, especially during non-contract months. So there's not a live cattle contract in July, so once you're comparing against August, you can get that kind of disparity. I would recommend looking at the 5-year average basis for both live cattle and feeder cattle when you're trying to come up with sort of an estimate for where basis would be in the future. And you can get that 5-year summary from iGrow, or give us a call here at the economics department. Looking at the feeder cattle futures, we got a similar type of chart here. We get this information from the Economic Research Service, overlay it with the futures prices at that time. This is from mid-February here. Little different story on the feeder side of things. The feeder cattle prices on the cash and future side have been running at a much stronger level compared to the fundamentals. We continue to see that here as well. So this is saying that in the feeder market, you're already at price levels at the high end of the fundamentals. That would say there's limited upside potential on the feeders, and perhaps you could have a softening or a little bit lower prices moving forward until they're back in line with fundamentals. From a strategy standpoint, if you're looking at selling feeder cattle, this is a signal to be pricing them right now instead of doing a protection strategy. Or if you turn that around, perhaps waiting a little bit on the cash side of things for the price level to fall or come back in line with fundamentals before putting a buying strategy in place as well. So downside from the buyer's perspective. Basis here is relevant as well. Very little basis, or I wouldn't worry so much about the basis level. It tends to be $2 or $3 when you're talking about feeders. Stockers, however, much bigger basis that you're involved with when you compare a cash price. This is the 5-year average of the cash price for a stocker versus either the CME feeder cattle index or the nearby futures contract for feeder cattle. You're going to see the same type of pattern. We've got a fairly strong basis level during the first half of the year, then a seasonal pressure or a summer pressure on that, and then a harvest time. If you think about big runs of fall calves coming, say in November there, that tends to weigh on the basis level. Taking a closer look at the stocker prices gives you a little bit of an indication of where they're at. The 5 to 6 weight steer price here for the beginning of 2013, running ahead of recent years, except when you compare it to where we were at last year at this time, where all the expectations were for very large corn crop and very low corn prices. That really fueled the calf price last spring. That's not the case this year because the expectations are similar. We'll have a large corn crop, but sort of the reality is we do need to ration the corn that is out there right now, and that's limiting feedlots' ability to bid up the calf price any higher. What used to be fairly strong seasonal patterns in the stocker market hasn't held as well the last couple of years, but we've had all these other disruptions to deal with there. What about long-range price projections? We do have another set of projections here. These baselines are from the Livestock Market Information Center, or LMIC. The raw range of prices that they put out are on the left-hand column, and then we've adjusted those price levels on the right-hand side using the basis numbers we've been discussing here. So for perspective, the live steer price and the feeder steer price for 2013 are down a little bit from the LMIC projections. The stockers down a little bit because we're adjusting from their feeder projection to account for the fact that their baseline deals with a Southern Plains calf price, and we're adjusting to use a South Dakota stocker price. So we get a little bit of a decrease this year, and we look ahead to next year, and the prices are in line when you look at those stocker projections. Any indications are, as the cattle inventory continues to tighten, you're going to have better live cattle price levels in 2014, but lower corn's going to mean that the feeder projection increases as well, and that carries over and gives you a better stocker price. Now I've got a few charts here that look at one particular set of scenarios relative to the volatility in the market. And there have been, at least other market analysts have talked about how the market's volatile. Well, it's a little bit misleading because in reality, if you're looking at laying off risk in the feeder and live cattle markets right now, the volatility is very low, and that means option protection at this time is very affordable. Start by taking a look at the feeder cattle volatility. This is from February 15th, looking at the September options contracts and pulling out the implied volatility. The range of volatility historically would have been anywhere from 10 up to 25%. Right now, regardless of the strike price, it tends to be about 12%. That's very, very low. This chart is intentionally very dull and boring to show you how quiet and still this market thinks future prices are expected to be. Will they be right or wrong? It's hard to say. To put it into perspective, let's look at how the volatility this year compares to the volatility over the last several years. Right now, the volatility in the feeder cattle market, when we talk about feeder cattle with an August end date, this is actually data backed out of the livestock risk protection premiums. The volatility right now is as low as it's been since 2006. So the high cost for option protection seen the last few years is not there in the market right now. Option protection and LRP protection is very inexpensive. What will this do through time? Looking at the last several years for what happens to the volatility with that September end date between now and September, you can see that there is somewhat of a tendency for it to increase before finally tailing off as you get very close to expiration. So the insurance is cheap when you no longer need it, is the end of that story. But in all of the recent years, the volatility level throughout the summer months has been much higher than it is at this time. The same pattern carries over to this very dull chart of the fed cattle side of things. Once again, we would be expecting volatility anywhere from that 15 up to even 25% level. And as of right now, it's very low in the live cattle side of things. So what does all this mean? And when we look farther ahead rather into the future, well, we have a few general conclusions. First, if we look at the LRP end dates, right now for fed cattle, there's been, you could get LRP coverage out through January 20th of 2014, and for feeder cattle out through September 23rd of 2013. The CME contracts on live cattle, they're trading out through June of 2014. Their options are trading out through April of 2014, and on the feeder cattle side, there's both feeder cattle futures and put options out through 2014. Bottom line, we've got pricing opportunities available right now, and the very last point is that the volatility in this market is being priced or expected to be very, very low. What does that mean? It means options, such as put options, are very inexpensive right now relative to the amount of coverage and the time of coverage that you've got available right now. So for the most part, when you're looking at strategies to implement anytime here in the short run, probably through the next, probably up until we get to the early summer or summer grazing period, I'd be looking hard at using put options first. On the live cattle side of things, there's upside potential, which suggests using that, and the volatility is very low. If you look at feeder cattle, there's limited upside, but the cheapest way to take advantage of that, especially if you're looking at running some calves on grass this summer, or if you still have feeder cattle to be marketed later this spring, the put options might still be a good alternative. If you're looking at calves, put options there might be a good alternative as well, or you could look at livestock risk protection. The volatility is low as a factor going into using LRP, livestock risk protection, which works fairly well on the calves. So that's the sort of the way I see the scenarios sort of playing out. Your big sources of risk are your feed risk, and then what's going to happen to the cattle cycle continues to be a risk. And in the short run here, the market's not pricing much of this risk or not charging much for you to lay off this risk in the feeder market complex. Should you like some more information, here's my contact information here, easily available through either iGrow.org or through the SDSU websites. Thank you very much for tuning in to this iGrow presentation. Tune in the coming weeks for the remaining Managing Change seminar series. Thank you.